Hello, everyone. Hope everyone is doing well. All right. So, as you may have been following the news, you know that on the 4th of July, President Trump signed into law the One Big Beautiful Bill. All right, so now this is not anymore. This is not like any proposals or suggestions or what we think might happen. This is already passed into law. We have to see how this will affect our tax situation because it's a little bit complicated because it has a lot of different provisions with different deadlines. I mean, different effective dates, different termination dates. Every provision has its own implications. So, what's in it, in what's the effect of this law on 2025? That's our goal for today to focus on. All right, so let's dive in. I'm gonna share my screen as usual. So let me share my presentation here. And as you all know, I like to start with a joke, and I found this one to be relevant because a lot of people go creative about tax deduction that are not legal. And that's why, because that's like today we're talking about a law that passed, meaning that if we're not in compliance with this law, we're being doing things in illegal way. And that's not our goal. Our goal is to use the law and to use the deductions are allowed that are allowed in it so that we can take deductions in a legal way. All right. So the stand for that One Big Beautiful Bill, we always say one OBBBA. It passed into law. So now what? As I said, there are a lot of tax breaks that are becoming permanent. They were introduced into the Tax Cuts and Jobs Act in 2017, and they were set to expire and at the end of this year. So some tax breaks are becoming permanent, but others are not. There are different effective dates, as we said, different termination dates and expiration dates for different provisions. There are various tax breaks that are reduced or eliminated or capped as your income reaches certain levels. So that makes tax planning very complex, but it also makes it more needed and more valued because you have to understand what's in it, how to use it, how to plan around it, how to use these deadlines and these dates and these income thresholds and all of that to work for you and not against you. All right, so let's dive in. And again, we're going to focus on the things that will be in effect in 2025 because there are certain things that are going to be in effect in future years. I'm not going to worry about this for today's presentation. So number one is standard deduction. So the OBBA extends, increase, and makes permanent the higher Tax Cuts and Jobs Act standard deduction. However, they were originally scheduled to be $15,000 for single, $30,000 for married filing jointly for 2025. However, under the new law, it's now becoming more. It's becoming 15,750 for single taxpayers and 31,500 because they made the inflation adjustment using a different prior year base. So they're not using the adjustment based on what it was last year. They used a different prior year pays, which is in this case it made it higher for us, higher deduction for us in 2025, which is good news. All right, so that's an additional 750 for singles or 1,500 for married filing jointly than it used to be. So that's the first thing. For itemized deduction, there is a new overall limitation that impacts taxpayers in the 37, which is the highest tax bracket now. It's a very complex calculation, but you just need to know that there is an overall limitation without getting into the specifics of what type of itemized deduction it is. Let's say you put all the limits for every single item, but then you add them all together. There is an overall limitation, and it doesn't affect everyone. It only affects those who are in the 37% tax bracket, and it's a little bit complicated. So we're not going to get into the details of this. You just need to know that there is one. All right. Charitable contribution for non-itemizers. So as a non-itemizer, if you're using the standard deduction, you know that you are not allowed any charitable contribution deduction. But now they're allowing you up to $1,000 if you're single, $2,000 for joint filers, which is also great news. Because now, even if you're not itemizing, you get to have some deduction. All right, what else? Senior tax deduction. So for people 65 or older, now there is a $6,000 deduction allowed per qualified individual. So if you and your spouse are both 65 or over, it's going to be $12,000. But this is a temporary deduction. It expires in 2028, but it helps with reducing your taxable income. However, it only applies to taxpayers with a MAGI, modified adjusted gross income, less than $75,000 for singles, $150,000 for married couples filing jointly, which limits the applicability of the deduction, unfortunately. But it is what it is. So bear in mind these thresholds, bear in mind the dates so that you can plan accordingly. All right, child tax credit. Child tax credit, so for every child, the credit increased from $2,000 to $2,200. So that's an additional $200 per qualifying a child. But also the credit phases out for higher income taxpayers beginning at a MAGI of $400,000 for married filing jointly, or half of that for others. All right. No tax on tips, and this is totally new, temporary, and only allowed starting 2025 till the end of 2028. So it allowed the deduction up to $25,000 for tips received by an individual in an occupation which customarily and regularly receive tips, including tip sharing. So this is valid for people working in restaurants and any kind of job that you accept tips. The deduction begins to phase out for when the taxpayer's MAGI exceed $150 or $300 for filing, for married filing jointly. And married couples have to file jointly to claim the deduction. So married filing separately kind of lose this $25,000. All right. No tax on overtime. So this is also temporary and allowed 2025 to 2028. And when we talk overtime here, we're talking not the entire amount of working overtime. No, we're talking about the difference between the regular pay rate and the overtime pay rate. So if you're being paid 1.5% of your regular rate, then the no tax is going to be on the 0.5. Or that half, that the additional or the extra amount, you don't get to pay taxes on it. Not that you don't get taxed on the whole overtime amount, right? And there is a maximum, and it's not $25,000 like the tips. No, it is $12,500 and $25,000 for married couples. So the maximum and the cap here is different. But the deduction phases out when the taxpayer's MAGI also exceed $150 or $300 for married filing jointly. And same thing, married couples have to file jointly to claim the deduction. All right. Car loan interest deduction. So this is totally brand new. We never used to deduct any loan interest or any credit card interest or any of that. So now they're introducing this new deduction only on car loan interest, not loans made to related party. And it is at $10,000 for qualified passenger vehicles. That includes cars, minivans, vans, SUVs, trucks, motorcycle, but it does not include campers or recreational vehicles. And it also begins to phase out when the taxpayers may exceed 100K or 200K for married filing jointly, and it's fully phased out if you're at 150 or 250 for married filing jointly. So it depends on your income. You really may not be able to make use of it, but if you are below the limit, then you're allowed up to $10,000. If the vehicle is assembled in the US and it must weigh $14,000, 14,000 pounds or less. All right. So what else? We have the Trump account. So this is a brand new thing as well. This is a tax advantage saving account for children born between 2025 and 2028 with $1,000 initial federal deposit. So for any newborn child in 2025, you get to have a $1,000 credit on your tax return if you open a Trump account. And the money grows tax deferred. So but bear in mind this $1,000 in a one-time thing. So it's not every year. It's a one-time thing when the child gets born. However, you can contribute as a parent. You can contribute into this child account $5,000 annually until the child gets to age 18, and you get to invest it in diversified U.S. stock index funds. And when the deductions gets when you distribute the money out, when the child takes a distribution out, the contribution goes tax free, and the earnings they get taxed as a long-term capital gain, not as ordinary. So it's more favorable and it's less rate usually than the ordinary income tax rate. And but the full value must be distributed by age 31. All right. This is in regard to Trump accounts. What else? We have the state and local tax deduction that a lot of people in high income tax states like New York, New Jersey, California, all these states with high taxes have been hurt by the cap of the 10K that was originally introduced by the Tax Cuts and Jobs Act. So now that it increased from 10K to 40K starting this year, starting 2025. And the cap keeps increasing by a small amount for each subsequent year until it reaches 41,624 in 2021, 2029. And in 2030, it reversed back to the 10K. And there is some limitation here because it's subject to MAGI inflation adjusted phase out threshold of 500,000 for 2025, at which point the limit gets reduced by 30% of the difference between the 500,000 and the actual AGI. So let's say your income is 600K or your AGI is 600K. So the difference is 100K. 600 minus 500 is 100K. 30% of that is 30K. You deduct it from the 40K, you get to the 10K. So now you're back to the same point. But let's say you're 550. And so 30% of the $50,000 difference. So you can reduce it, but you don't go to less than 10,000. So your $10,000 is the minimum you can get. Of course, if your taxes are higher than that, but if you're in a state where your taxes is already $6,000 something, then this is not what we're talking about here. We're talking about if you're paying too much taxes, but your AGI may hurt you and may not allow you the full deduction, even though you paid more than 40K in taxes. All right. Energy credit termination. So under the prior law, clean vehicle and associated tax credit was supposed to sunset after 2032, but the one big beautiful bill accelerate the sunset For the clean vehicle credit, whether it's new, used, or qualified commercial, it's set to expire on September 30, 2025. So you have to bear in mind that if you need to buy the car, you need to buy it by this date. If you still are considering it, getting a clean vehicle and you want to get the credit for it. If you get it after, you lose the credit. Energy efficient home improvement credit, it's you still have till the end of the year. Residential clean energy, including solar, also you still have till the end of the year. There are some others that have different dates in 2026. Again, we're only focusing on 2025 for now. Bonus depreciation. So for businesses, and you've been waiting for this, you wanted to have restoration of the 100% bonus depreciation that been phasing out over the last couple of years. So bonus depreciation for anything you buy after January 19, 2025, and you put in service after 19, 2025. So this is primarily applied to tangible property with a recovery period of 20 years or less. If you got it or if you put it in service January 18, sorry, you're not qualified for the 100% bonus depreciation. For 179 expensing, though, the limit has increased and it goes into effect January 1st, 2025. And the limit went up from 1 million to 2.5 million and the phase out from 2.5 to 4 million. So that would bring a lot of savings to so many businesses. Last but not least, the R&E expensing. So now businesses can immediately deduct the domestic research and experimental expenditures for tax years beginning January 1st, 2025. Before that, it used to, you have to amortize the expenditure over like 15 years, or depends what kind of expense it is, to amortize it, and you don't get immediate expense for it. And it wasn't even if you're not getting the credit, it was not something that you had an option to do. You had to do that. You had to amortize it. Now only the foreign R&D have to be amortized over 15 years. But small businesses now with average gross receipts under 31 million, they can retroactively apply this change to tax years beginning after 2021. So you can go back and amend prior year returns if you were amortizing this expense instead of expensing it in full. All businesses may elect to accelerate the remaining deduction for R&D expenses incurred between 2022 and 2024 over 1 or 2 years. Depends on if that will bring them more savings and they don't have to go back to amend. All right, so I think I threw a lot of things on you now. The law is like 940 pages. It's full of things that are like affecting everyone on the personal side, on the business side. And if you are still not sure how this is going to affect you, you're not familiar with all these provisions, you're still confused about how this will affect you this year, please reach out. Let's do like a session of tax analysis on your own situation to be customized to you based on your personal situation. All right, hopefully you found this to be helpful. And if you have any questions, please reach out. Thank you so much.